Welcome to Calm Trader channel. If you are getting into option trading, you are likely excited about the potential profits, but you might also be feeling a bit overwhelmed. The world of options is filled with opportunities, but it's also full of common mistakes that can cost you big if you are not careful. We are going to walk through 5 major mistakes that many option traders, especially beginners, make. By understanding and avoiding these mistakes, you can increase your chances of success and make smarter decisions in your trades. Let's jump right into it. Mistake 1: not understanding how options work. This might seem obvious, but you would be surprised how many people dive into option trading without truly understanding the basics. Options are complex, and if you don't understand the difference between call options and the put options, or how strike prices and how expiry date work, you are setting yourself up for trouble. For example, let's say you buy a call option for stock XYZ at a strike price of 50 rupees. You think the stock will go up and you are excited to see profits. But here is the problem: if you don't fully understand how time decay works, you could lose money even if the stock price goes up, just because your option expires before the move you are hoping for happens. A common mistake is thinking that you will make money every time the stock moves in the direction you want. But time decay works against you, and implied volatility can affect your option's price, even if the stock moves exactly the way you thought it would. If the price of XYZ stock doesn't rise above 50 rupees, or if it doesn't rise quickly enough, your option could expire worthless. Understanding the mechanics of options like strike prices, expiry dates, and time decay can help you avoid unnecessary losses. You don't want to just gamble on the stock moving your way. You need a clear strategy. Mistake 2: failing to have a clear exit strategy. Here is the thing: many traders focus so much on getting into a trade that they forget about the most important part: getting out. You buy a call option on a stock expecting it to rise. The stock hits 52 rupees and you are feeling pretty good about yourself. But you didn't set a target price or a stop loss. So instead of selling and locking in your profits, you hold on, thinking the stock will keep going higher. The next thing you know, the stock drops back down to 50 rupees and your call option loses its value. This happens all the time when traders don't have a plan for when to exit the trade. Without a clear exit strategy, you can let emotions like greed or fear take over, leading you to make poor decisions. Let's say your initial target was 55 rupees. You should sell your option when the stock hits that price. No hesitation. If the stock moves against you, you should have a stop loss in place to protect yourself. Trading without an exit plan is like setting off on a road trip without knowing where your destination is. Remember, it's not about predicting the market perfectly. It's about knowing when to cut your losses or take profits. Mistake 3: over leveraging. Option trading is attractive because it allows you to control a large number of shares with relatively small capital. Many beginners think they can make huge profits without considering the risks involved, and they end up over leveraging themselves. Let me tell you what that looks like. Let's say you have 1 lakh rupees to trade. You decide to buy a lot of call options betting on multiple stocks, but you are so focused on a potential profits that you don't consider how much you stand to lose. Suddenly, a few of your trades go in opposite direction and you have lost almost all your capital in one go. Over leveraging means putting all your eggs in one basket, using most or all of your capital on a single trade or a few trades. This is a big mistake. A single bad trade can wipe out a large portion of your account if you are not careful. To avoid over leveraging, always make sure that you are only risking a small percentage of your account on each trade. A good rule of thumb is to risk no more than 1 to 2% of your account balance on a single trade. This way you can survive a losing streak and still have capital to continue trading. Mistake 4. Ignoring risk management. Speaking of risk, many new option traders forget to manage their risk properly. They focus too much on how much they can win and not enough on how much they can lose, especially when you are trading options with limited time. Let's say you are excited about buying a call option for stock ABC at 100 rupees, expecting it to soar. You don't set a stop loss because you believe it will hit 120 rupees soon. But to your surprise, the stock doesn't go up as you predicted. It drops to 95, your call options value falls sharply, and now you are stuck with a large loss. Without proper risk management, you are just gambling. Successful traders use stop loss orders to limit potential losses and ensure that they don't lose more than they are comfortable with. Setting realistic risk to reward ratios is also important. For example, if you are risking 1000 rupees on a trade, make sure your potential reward is greater than that. Setting realistic risk to reward ratios is also important. For example, if you are risking 1000 rupees on a trade, make sure your potential reward is greater than that 2000 or more. When you implement a solid risk management strategy, you protect yourself from blowing up your account on a single bad trade. Mistake 5. Chasing hot tips and following the crowd. One of the worst things you can do in options trading is to follow the crowd without doing your own research. Just because someone on social media or a financial guru says that a stock is going to explode doesn't mean it will. Chasing after these hot tips can lead to big losses. For instance, let's say you see an influencer on Twitter talking about how stock XYZ is going to skyrocket. Everyone in the comments is hyped up and you decide to jump in and buy call options. But you didn't bother looking at the company's fundamentals, the chart, or any potential news. The stock doesn't go up as expected and instead crashes. Your options lose value and you are left with nothing. Just because a stock is getting attention doesn't mean it's a good trade. Always do your own research before entering a trade. Look at the stock's past performance, analyze the market conditions, and use tools like technical analysis to guide your decisions. Don't fall for the hype or just follow the crowd. Take the time to understand what you are trading and why. So, to wrap things up, here are 5 mistakes you need to avoid in option trading. 1. Not fully understanding how options work. 2. Failing to have a clear exit strategy. 3. Over leveraging and risking too much. 4. Ignoring proper risk management. 5. Chasing after hot tips without doing your research. Remember, option trading can be rewarding, but it requires patience, discipline, and solid understanding of the market. By avoiding these mistakes, you will be in a much better position to make smarter and more informed trades. If you found this video is helpful, make sure to like, share, and subscribe for more tips on how to trade smarter and avoid common pitfalls. Thanks for watching and good luck with your trades.